Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, February 28th, 2022. So as we embark on the last trading day of the month, that's going to be significant because we're going to keep an eye on our monthly charts. Again, I talked about that. Nothing really is likely to change today based on where we're at. Just to kind of summarize that, we're down below trendline resistance after a solid sell signal, so that sell signal is still very much intact. But we've also successfully tested the 20 period exponential moving average. That's again on the monthly chart. Does a great job at defining support and resistance. So that's that. Weekly chart. We had last week's close was a stick save. So this is most important right now to me, and the one that's formulating. Again, I speak to both active traders, very short-term trades, and also trend traders and investors. And in fact, there was a good question put to me in the on the site today in the comment section. And so I like to, address these from time to time. And that question was, with your belief that QQQ is heading for further pain, are there long entry points for individual positions, i.e., FANGs or cryptos that we should be watching? I guess I kind of quick glance at this morning, and I'll get to that. And I always cover the FANGs, by the way, and they will. Let me just say this, because I answered really speaking to the equity markets, and it's one and the same. Because if QQQ holds and bounces and these divergences play out, then the market rallies. I'll get to crypto here in a second as well, but I wanted to answer this because, again, I think it goes to individual stocks. In this day and age, more so than at any point in time in history, and it just continues to build. It's all about indexing. Over time, more and more people use ETFs and mutual funds that track the major stock indexes. So here's my response. So the answer was yes, it depends on one's time frame and trading style. Or yes, but that depends on it. As of now, we have many key stocks and sectors successfully testing and bouncing off key supports and trend lines at last week's lows. Let me digress. That I covered in a recent video. So that's the technical catalyst for the bounce. And most of those had positive divergences, as well as positive divergences on the major indexes. As such, one could go long here with stops below the recent lows. And yes, we're off those lows, but still, if the divergences and everything are going to play out, then that's a significant bottom that certainly has the potential to be the catalyst to move to at least test, if not take out the previous highs. So I'm digressing. You can check out what I said here, but so that is it. So to answer that question, I'm either going to be right or wrong, and I've said that all along on where if my deeper targets are hit this year or anytime coming up soon. To go on from there, should the recent lows get taken out soon, then the odds that QQQ, SPY, and IWM fall down to my next targets on the weekly charts will increase substantially. So one could also go long there, or ideally, if at my final target on QQQ for investor and trend traders. But that depends on how the charts look if and when we get there. So in other words, now or anytime last week when we hit those supports is an objective long entry because we have, and I'm going to go over that now in the charts, or which I'm still leaning to at this point. I'm going to go over a few things. If we head down to those next targets, then that would be an obviously much better place. You're going to be buying the same stocks, market-leading FANGs or the indexes. It's substantially cheaper price as well. It should be, we'll get to it in a second, probably 20% or more cheaper, at least, than we are at today. But again, this may be the bottom. I'm going to go over the charts in a second here. Let's dive into that now. Let's get back to the charts. So again, by far the most important technically significant event that happened recently was this. We had a intra-week break of my first target level, and again, I'm focused on QQQ, but we had SPY, IWM had support there as well, only to see a successful print back above, a hair. Again, we can say we're on it and it's back testing. I mentioned that last week. We haven't clearly taken it out yet, but the fact that we dipped way down below and had a surge of buying come in, and whether or not that had anything to do with the government, gunning the futures or let's say the PPT or the president, commissioning the banks to do so. It doesn't matter. That thing about technical analysis, it doesn't matter who the buyer is. It does in a long-term sense. If it's a government, they have to, banks temporarily holding those positions. They're not going to archive them away like a long-term investor might have bought Apple on the dip and plan to hold it until he or she takes their dirt nap, or at least for the next 30-40%. In other words, investors might buy dips and plan to hold that for long term. All that matters is we did reverse, and that support has still not been taken out. So we still do not have a solid check mark here for the bears, which we need, and that is again a weekly close below my first target level on QQQ and the you know, correlating levels on IWM and SPY as well. And now it's week 2 and we're still above it. So as of right now, bulls get the check mark on this. Again, my most important chart for swing and trend trading. It's a successful defense. And if they can print the week green, and the greener the better for them, then that would be a confirming check mark. Remember, this is a weekly chart. It's 10:42 Eastern time right now. That means we have the entire week, less just over an hour to go, and so a lot can happen. But that's what we're going to look like here. Again, no change on the monthly chart. But if you wait for changes on the monthly chart to change your positioning, if you're all in short or all in long and you wait for those sell signals to be confirmed, by that time that happens, you can be so underwater, it's well beyond any reasonable stop. So this is a more actionable chart for investors, if you will, and trend traders. And then swing traders can focus on the shorter term charts as well, more active swing traders. But that's it. So I'm not going to beat a dead horse. I am going to say we are still at and testing my first support level. And the fact that we had a big dip down, and it was the Bears, the ball was in the Bears' courts, and they did not capitalize on it. Again, I'm speaking metaphorically. Whatever the forces are, there was overwhelming buying that came in to reverse a big interweek drop, and right now we're back above it. So that is, I'm not calling it a false breakdown or a whipsaw because, again, the weekly candle never finalized, but I am saying that we went down quite a bit. We didn't just go there and test like the previous week where we tested it, parked on it. We went way down, reverse, and we're still holding those gains now. But again, the week is young. All right, so hopefully that makes sense. We're watching this, and then we still have quite a bit of resistance overhead. I've compared previous similar corrections. Remember, you got to go to the big ones, especially if I'm making the case that there's going to be a lot more downside. Right now, this has just been a run-of-the-mill pullback, especially in the S&P 500. It barely met the definition for a correction, although it was about from high to low, close to a 20% or so drop in the Qs. The tech-heavy QQQs, they are higher beta. It's a higher beta index, meaning it goes up and down more than the S&P 500. 21% drop from high to low, so certainly a healthy correction, profitable to trade. If you were short anywhere up near all those early sell signals, you're still very profitable as a trend trader. You're just not going to there's no reason or out there to let a healthy loss completely evaporated. This is where you need to define your trading style and time frame and stick to your plan. Again, every trade, you should have a trading plan before you go in. And my trading plans will evolve and they're flexible. Remember, we started shorting looking at the 60-minute chart back there. All these entries were initially on the 60-minute chart. And it was only here where I started morphing over to putting a higher emphasis on the daily and weekly chart. And so that's where, again, speaking of those trend trades, that's where we're at. So as of now, no concerns. But if we end up and looks like as we're heading into the week, we're going to come up here. I'll talk about the levels there and where a bounce is likely to cap. And again, there's no possible way to rule out the fact that the correction may be over. Only time's going to tell, but I'm going to show you things to watch. And before we get away from the weekly charts, I just wanted to talk on things like this. IWM still massive resistance up there around 209 or so, and we need to see. The other thing I've been harping on for the last couple of weeks are these bear flags, and what we're seeing here is they're not eliminated yet. Ideally, you want to see an impulsive move down, equally as impulsive as coming into the flag, i.e. the flagpole. One green candle in the way doesn't foil it at all, but two, especially if we close the week up here, will at least in my opinion, foil those because it's not textbook. I like to see clean textbook flags. And right now, again, it's a weekly chart, and that's where the flags were. They weren't on the daily chart. Really weren't showing well there. This week, to keep that going, of course, we still have to take out the recent lows. And on IWM, it was a hair below that target I had there, the first level, 192.15. Really, this is the low down here. It's about 188. So again, until and unless we take out those lows, there is certainly the case that the correction's over. I still think this is still my preferred scenario, but it's all about probability and odds. And based on that reversal last week and the stick save, especially on QQQ, well, I trade in real time. My odds, and it's just like, if you've ever been, I went, not a big gambler, but I went to the Kentucky Derby once, and I remember watching the odds on the horses change right before the race. They're going up and down depending on how the betting is. As people are walking up to the windows and laying bets, the odds, especially on some horses, can change drastically, and right before the race starts, and then boom, once the race starts or right before it, they lock it in, and those are the final odds you're going to get paid out on. But if you bet too early, you might have odds that you think are great in your favor, and you really have a good strong feeling about that horse. Well, guess what? By the time the race starts, those odds may have gone down to 2-1 or whatever, 1-1, where you're getting your 1-1 to get your dollar back, or every dollar you bet. So I'm just trying to say that's how I look at the market. So if it's confusing to you guys, it's all in real time. And right now, again, it's really what I was saying a few weeks. We got to take out the recent lows, and that hasn't happened. And the fact that we, had a big reversal. Yeah, it certainly decreases the odds, but does not eliminate them. There is a lot of resistance overhead, and I'll just do these updates every day and tell you the levels to watch. There's a potential downtrend line on IWM. You could maybe, if we go a little higher, it could come in like that. Why did I move it? Well, you start out on major reaction highs on the downtrend line. That one captures the wick, or the skinny part, the shadow of that candle right there. And the way I did it here, a lot of times I'll draw it down to the bodies, and we'll see where a reaction is. So if it's that one, it comes into the wick, then we could push a little higher and make a second back test to 209. But anything much more than that, just simply a break back above the bottom of that zone would be bullish. And again, this is IWM. Bigger weighting will go to S&P 500 and QQQ, but we'll watch them all collectively, because that is the stock market. If you want to know what the stock market is doing, well, the S&P 500 and the NASDAQ 100 only contain the largest companies out there. They are the biggest mega cap companies, multi-billion and even trillion-dollar companies. So, and IWM are the small caps, the other end of the spectrum. And there's MDY in the middle, but that is the market, or you could look at the Wilshire 5000. Okay, guys, you know my thoughts. You know where we're at. And you know what I think needs to happen today. Ideally, you'd want to see a breakdown, a break of those support levels, and the sooner the better. Again, it just increases odds. If we could get a big down week this week, with those flags, the potential for them to play out are still intact. If we move around sideways for this week, especially in the next, it doesn't eliminate the chances of us going to my targets, but it reduces it, because it took away one nice component, those bear flags, and how they should play out. And again, they're really holding up today, first day of this week so far. Again, didn't help. If we would have gapped down big today, and the futures were down big last night, but they bottom up again. So, all right, hopefully that makes sense. Try not to be wishy-washy, but you got to, all these, it's not simple black and white stuff when you're trading. Let me show you something else here. Okay, we're on the daily chart, and this is SPY, the S&P 500. And so there's your divergence, and that's, to me, I'm sorry if I admire it this way. It's beautiful divergence. I like to see these clean, this clean separation between the troughs, and divergence like that, and that's what you have there. And again, I've talked about it quite often, meaning more often than not, but that's far from always. More often than not, positive divergences play out for a trend reversal, especially once they're confirmed, a lasting, and it's commensurate with the time frame. So on daily positive divergences, I'm not looking for a 5% bounce. You're looking usually, especially in a bull trend, a substantial bounce measuring well into the double digits, and quite often in a bull trend, that would be the catalyst for a move to new highs. So it's certainly the potential there. It's still what I call unconfirmed divergences. This is something else I'm watching, especially this week. A solid crossover on the PPO, meaning the orange line there, the PPO line crosses up above that signal line, the white line, and then you effectively have put in that lower low. As of now, it could still turn down, but that's it. I wanted to point out these positive divergences, which I did. I've been pointing out. There it is on QQQ, about to cross, poised to cross over. But just like IWM a minute ago, I gave you a downtrend line off the highs. You can see, so you've got quite a bit of resistance. And I just look at it this way: each of these, if taken out, that downtrend line right there, then horizontal resistance levels, then all the moving averages, the big ones, the 200-day moving averages, if and as they're taken out, check marks. But if we go up and hit them and get rejected, especially impulsively, or fail to get through those are check marks for the bears. So it's like a close game. Remember this, this last season we had some of the best playoff games in history leading up to the Super Bowl. They were down to the wire, overtimes, all that, and it's like you can't call it. You just got to look play by play. It's once they get down to the wire like that. And right now that's it. So it's anybody's game. The onus is on the bulls to take these divergences and run, take out these levels, and if so, boom, great. Whereas the bears, they already have sell signals on the weekly chart that are still intact, and trend indicators, some that have rolled over all the way out on the monthly charts, and so they need to take those divergences out. So now let's talk about those divergences one last time. Let's go back to the S&P 500, and again, in using comparisons, there's only a few. If again, I'm making the case for a much bigger top, and so far, once again, just to reiterate, although it's been technically top to low, if you want to count it that way, not closing values, bear market in the S&P 5, or I'm sorry, the Nasdaq 100, but from high to low on the S&P 500, you see if I grab that candle, the very top. It's not where we closed. That was the intraday high to the intraday low down there, 14.5%. Look at closing values, it's going to be different. It's going to be much different, actually. You look at closing values, it's going to only be about 10%. Again, like what I told you a minute ago. So just the bare minimum definition of a correction, 10% drop off the highs. All right, here's what I want to do for you real quick. Bear with me. We're going to go back. We can say that when COVID hit, it took the market so fast, you didn't have any divergences. The drop was pretty big. In fact, it was one of the most powerful drops in the history of the markets. You had Black Monday and all that back then, but in a market with circuit breakers, post-circuit breakers, I should say, post-87, certainly one of the biggest and fastest drops in the S&P, wiped out 36% in a matter of just over a month there. Very impressive. So not the best comparison right now because we don't have that going on. Now that entailed economic shutdowns. We're going to compare the next biggest drop, fourth quarter 2018. And I know I've done this comparison, but one thing, there's something new here in this video. We're going to look at the divergences I talk about. And again, I say more often than not, which is not always, those divergences play out for a trend reversal. I'm sorry, I marked them up on QQQ. I thought I would had them on SPY. It could go back. It'd probably be the same thing here. Here's what I'm doing. I'm going to QQQ, and we're zooming in nice and tight. Let me take this in. This is a close-up view right here of the drop, the fourth quarter drop, the drop in Q4, which from high to low in QQQ was about almost 24%. You can see it there in the pop-up box to the left, 23.58%. All right, so during that one, we had, as you can see here, we started to fall, and from this point right here on the RSI, right here, see this red line? I'm going over it with a blue marker. That, and then at this point here on the PPO, so on the RSI from here to here, all the way down to this low, that major low right there, that reaction low, which is where, again, if I'm going from memory is correct, you can go back. All these trades are archived. We were short here on sell signals, and we covered right around there and reversed along and then went short again and then covered not too far off there. So we gamed that almost perfectly. And I want to say that at that point, we had what I, again, look at beautiful textbook positive divergence right here on the PPO and RSI. So there's one example. and it's a divergence that I chose to appreciate from an active trading perspective because we covered those shorts. Final target was hit, reversed along, but then got short again, and look what happened. They got burned. By burned through, it means you had them in place, well intact. They started to play out, and it was impressive. Again, impressive for a short-term trade. And again, a trade that we were able to gain most or a good part of. That was a 9.75 rounded up here. Call it 10% counter trend rally. Look at that, right back to the 200-day simple moving average, and really right around there's the 200 exponential. So on a closing basis, that's where we parked. Intraday, we hit the 200 simple. Remember, we already had one test and failure of it right here after a successful test and bounce there. So 2 tests of the 200 days, and then it gave up the ghost. So you had what was very impressive counter trend rally. There's a huge green candle in there, comparable to the big day we just had. But those divergences, unlike most other points back in time, did not play out for a move to new highs. Instead, from there, if you started buying into that rally, just like let's say maybe today, if you buy today, I said you can buy it if you think the market's going to new highs, within the matter of just 15 trading days, no, let me get it right on there, 21 calendar days, which is 14 trading days. So in 3 weeks, the Qs turned around and plunged another 17% from there before finally bottoming. And so that positive divergence failed to play out, but you did have at that end, you had RSI divergence, positive divergence on the RSI from this point to that point. Okay, so that's it. That's the whole takeaway, is that more often than not, those divergences play out for much bigger, larger moves. Trend changes on the daily chart. When you get a trend change, right now we've been in a bearish trend. Remember, the Nasdaq 100, which is my primary focus, peaked all the way back in November 22nd, and now that's been 3.2 months. So we're still in a downtrend, and despite the recent strength, again, it may be the beginning of a new run to new highs, or it may be just another counter trend rally. This is by definition a downtrend. So that's that. Resistance levels. All right, and so that's it. Let me get off that and look at a few other things, and we will wrap this video up. I wanted to cover the VIX, put to call ratios and sentiment, and then a quick update on gold and silver. Okay, here's a weekly chart of the VIX Volatility Index, and you can see here, that one's not marked, but see that I'm drawing, there's positive divergence right here, and a downtrend line which was popped, and a huge run up in the VIX. Each and every one of these pops, remember the VIX, these big spikes come from corrections or bear markets in the stock market. So you had one there. Actually, this period really goes back to just after the last last bear market. I'm sorry. So throughout these were bull market corrections, and you can see quite often right here and here they're not all marked. You had positive divergence, boom, explosion, and you also had a trend line that was taken out. Boom, another one. That one didn't go so far. We put in another divergent low. The VIX found a new bottom. That was a multi-year, I believe, historical low end of the range on the VIX, period of extreme low volatility in the stock markets. But ultimately, you popped and had a big spike there. So you can see it's kind of like an EKG. Every now and then you get these corrections. They're usually indicated by, you can see nice clean, trend line breaks, and you pop and the VIX goes. So here's where we're at. Most recently, you had a downtrend line there, and you had, at this point right here, really positive divergence at that low, and you went and broke out. And we're moving higher, but we're at resistance. This is my resistance level. It's a rough area here. Again, this is a weekly chart. I showed you the daily chart last week, and you can see we hit my 3761 level. It's resistance level I've had here a long time. We hit it again just late last week. But look, the VIX is still in an uptrend. So bottom line is, hey, nice reversal off the lows last week, positive divergence. I can make a pretty damn good case to go long right now. Back 401k, fully invested long equities. And again, I told you, if you want to do it, the recent lows are really, it's probably one of the most clear-cut cases, because we're still not, relatively speaking. Again, relative is if you're looking for new highs and beyond, you're looking for another 30-40% upside in the market. then you're still, as much as the move was off the lows last week, it's still not that far away. So that's an objective stop, because I think if those lows get taken out, the bottom will fall out of the market. So, but this it's not. This is saying it's not clear to go back in the water yet, because we haven't fallen back to the bottom of the trading range. The VIX is still elevated, and could at any day now, tomorrow, today, pop that resistance. If it does, that probably means that the recent lows have been taken out or will soon be taken out. So I just wanted to point that out. The VIX is still very elevated, and that just again means it's not safe to get back in the water. Again, manage a position. If you start moving back down towards those lows, just remember that if we start to reverse and get anywhere close to them and then close, and you're in things like mutual funds or ETFs or individual stocks that you can't trade overnight, like the futures could turn around and tank and rip down and then gap down below those lows. But as of now, we're not close to them, so trade as you want. Just wanted to point that out on the VIX. And then VXX is our proxy, one of those. All right, another video pause snafu. I've got to reach out to the company and do something about this. A lot of times I'll hit the pause button and it'll pause or unpause, and sometimes it doesn't do it, and there's no indication whether you're recording or not if you're not watching the counter. So my apologies. I'm just going back because I don't know if the coverage of the VIX worked. I paused it as I transitioned from covering the VIX to VXX. But just in a nutshell, here's where we're at on the weekly. I just wanted to say you get these divergent lows going back. This is throughout the entire bull market since 2009 lows here. You get these little trend line breaks right there in the VIX spikes. It surges, and those are your, they correlate with corrections in the stock market, and they all happen from different levels. This was a historic low range of the VIX right here, but most recently in the past, this has been support around the 16 level. And I just want to say that the VIX did, as it often does, put in a divergent low recently and then took out trendline resistance. It's been moving up, and on the daily chart, we hit had resistance here for a long time at 37.61, give or take. We've come up to that level quite a bit. We hit it the other day, and we're still in relative close proximity. The VIX has not faded back yet. No, if we keep going up, if the market keeps rallying and holds those levels, takes out the 200 days, yeah, the VIX will come back down. As of now, it is still anybody's game, and based on where we're at, I'm still, like I said, leaning towards that reversal, but I talked about it, changes day to day. And then VXX, I was saying we hit my second target here, laid that out for you, back a couple months back. T2 was hit, almost hit again. We're still elevated. If we can pop the recent highs in the VIX, then it should open the door to these next targets. And if some reason the market's bottom, then that's it. And you don't want to hold this one. You do not want to tuck this one away once it is clear, or starts to become clear, that the correction ended at last week's lows. Because the VIX over time, this particular instrument, these VIX tracking ETNs, will just lose money over time. They're hit and run investments. Get in when you think there's a move in the market, and then get out when your targets, when you think the end of the correction or bear market is over. And let me add to that, even if we have entered into a new bear market with a lot more downside to come, you want to get out on each of the major counter trend rallies. So in other words, some of my targets are hit on the weekly charts. If I expect a bounce there, then you want to get out, because the VIX will bleed off. If I'm right and we're going to break the recent lows, we're going to shoot way up. It's going to be a big move in the VIX, but then when we hit some of the major downside weekly targets, if we bounce from there, the VIX will bleed off very fast. So you got to be quick and nimble if you're going to trade that. Don't tuck it away. Don't hold on to it if it becomes apparent that the market the correction's over. And next up, before we go into gold and silver, and that'll be very brief, I just want to do an update on the sentiment indicators. And this one, we're going to look at the CPCE, two different charts. That's the put to call ratio with weekly. This is the put to call ratio, these black lines here. And what I like to do on this chart is overlay a 100-period moving average, a simple 100-period simple moving average. And that's something I developed over the years. You have a level at about 0.62 And when the CPCE on the weekly falls to that level, there's the initial tag. At least going back, where are we looking at? Going into at least back to at least 2004 at the end of the chart here. So we're spanning a couple decades close to it. And you can see when the initial tag came with 0 failures, and that means, what does it mean when the initial tag of that 100-day? I like to use a moving average because it smooths out the bumps. When you look at the put to call ratio, it looks like an EKG because corrections sometimes, for whatever reason, various market forces, things going on, you can see people surge into buy a bunch of puts or buy a bunch of calls, but this is a contrary indicator. It is a sentiment indicator. It's one of the most effective because it shows you where people are placing their bets. And when the put to call ratio is high, it means people are buying a lot more puts than they are calls, right? And when the put to call ratio is very low, it means people are buying a lot more calls than puts. Now you can see here, I have a couple arrows I'm going to show you. This one up top, they're already marked, initial tag. That's when we fell to that line, and then you can see we stayed on that line. That shows you it, and on average, again, smoothing out using a moving average because that's what it does. We had a period about a year long of persistent bullishness with extreme low put to call ratio, meaning there was a lot more call buying, people, especially on individual stocks, placing bullish bets. A call is a bullish bet that a stock will go up versus puts. And the other use of puts and calls options is hedging. And so institutions or more savvy individual investors will buy puts to hedge, but when they think there's not a lot of reason to be hedged, then they're not buying a lot of puts. So you can see it hit there, and then that was back shortly after that. Like I said, there's always a lag time of up to a year or so. The top came in on the market, and that was followed by a 57, about a 57, 56% drop. Bear market, one of the worst in one of the worst in history. And then you had, and that's just the S&P. I'm not even using the Nasdaq. Then you had the initial tag right here. Again, took about a quarter or about 3 months, and then a 21.5% drop. That was back in early 11. We hit it here, initial tag, stayed low, and again about 3, 5, 6 months later, something, 16% drop, actually twice, and that was about over a year of sideways to down trading in the market. So all I'm saying is this one caught the biggest drops that we've had. Not all of them, I'm sorry, didn't catch COVID, but it didn't have any false whipsaws, false signals, and there it is. We had the initial tag happen all the way back here. And again, it was a little less than, it's been a while, but it took about a year. Again, you always hit it first, and then you have periods of persistent bullishness. Remember, a low CPCE is persistent bullishness. And we hit an extreme. We've never seen bullishness this high. In other words, such a low put to call ratio. And we're still well below there. And so far, we've had about a 14, almost 15% drop. Remember, that's high to low in the S&P. And based on the scope of this, you would think there'd be more. Maybe, maybe not. But it was effective in calling. That was the biggest drop since COVID so far. And the million-dollar question, is there more? Let me show you one last chart, then we'll move on to gold and silver, and we'll wrap up. Okay, this is also the CPCE, except we're using a daily chart. So the black lines right there are the CPCE. Red line, I have a moving average in there. But the takeaways or the key features on this chart is I've set up a long time ago, about 1.12 or 1.13, a line right here. That line, and anything above it is green. It's my buy zone. And down here I have a red zone, and that's at about 0.38. And again, it's showing you, and on this I use the individual tags. I know in the video you might not be able to make it out as clear, but I'll just use the arrow tool. We did not hit it there. That one was close. This one hit. All the circles. I'm just going to, let me just clean this out and tell you. You can pause the video, zoom it in. We hit it there, there, there. And this is, and I often talk about this, If you have multiple readings in close proximity, it's a cluster. It's a period of, instead of just an extreme, a brief period where everybody got too bullish, because this is extreme bullishness. If the PC put to call ratio, equity put to call ratio drops this low, it's an extreme outlier. This is, look, we're going back before the last bear market ended. We're going back into '08, and you can see with zero exceptions, here's what happens. When you hit that low, you had these drops, all these in red circled. This one led to, again, over a year long sideways to down. It was a down market, and it took a long time to recover. It wasn't just a quick correction. Here you hit it. These are all persistent readings. I've been harping on it for a while. Okay, so all right, Randy, you're right. It finally led to a little bit of a down move. But that's not the only takeaway. The other takeaway is, usually, but not always, those big drops end with a spike. Look at where the spike, especially here's the biggest drop since, again, this was the end of the last bear market, right? This is when the bull market started, March '09. So we're looking here. So you had that was the biggest drop up to that point. You can see we spiked up almost to my green buy zone. Here you had, that was kind of like a check, initial drop. And again, this put us in, it was almost a year and a half long, close to a 2-year sideways or a deer market. Stocks didn't go up at all. They went down quite a bit in there, and then they finally broke out above that range here. So that's when they took off. And look what it took to end. You had to have this extreme bearishness. See these two spikes, two consecutive tags, or a cluster right there, and then off to the races, okay? Because what happened here is we were in correction mode, but they weren't getting bearish enough. And it took this kind of bearishness to end. Right here, oops, I hit the wrong key. There's that big Q4 2018 drop I always reference right there. What did it take for that to end right before the end of the year? Boom, hit my buy zone. Perfect tag, and coincided perfectly with the bottom, and then that was the best time to get in many, many years right there. What happened when COVID hit? Boom, you got it right at the lows, an extreme spike, hit my buy zone. So you don't get these buy zones a lot. Okay, now where's the takeaway? Not every correction ended with a move all the way up. Most came close or hit it. This one, here's the thing. We haven't even spiked anywhere even close up there. What I'm showing you here is there's no fear. On this indicator, there's no fear. Yeah, we've come off the lows, but we haven't had anything remotely close to the spikes that coincided with fear. And so, it's a contrary indicator that tells you, hey, there may be quite a bit more to come, because market participants are not afraid. They think the Fed put, they believe, or whatever reason, doesn't matter what their thinking is. But I'm just showing you from this indicator. It's not at all remotely conducive with the end of a significant correction, as far as this one indicator goes, that is. Gold and silver, I said I'd do it quick, and the video's gone on quite a bit, so I'm going to keep it simple. There's my symmetrical triangle. Been waiting for breakout. We got the breakout recently, and the breakout is still very, very much intact. We ran at that previous high. We're having a little bit of a consolidation around there. So from this perspective, no problemo. It still looks good, and I still remain bullish gold. That's what gold looks like on the 60-minute or 120-minute chart at GC. There's a rough uptrend line. It's not perfect. You could draw one that way too, off these lows, but we're still above trend. The breakout's still intact right now, and still treating pullbacks in gold as buying opportunities. Same with silver. Silver's still walking up the uptrend line on the 120-minute chart there, and then going back to that daily chart or the weekly chart. SLV, silver is still above the breakout level there. There was our downtrend line, broke out last week and follow through so far this week. So still bullish on those. And then last but not least, let me show the Euro US dollar. This is why I remain quite bullish on gold and silver. Okay, so I've talked many, many times in the past. I don't have time to show you visually. It'll take too long. I got to wrap this video. We're stretching the limits of what I like to do time-wise, but I showed you there is a very, very strong, especially historically, when you go back, not just day to day, but the trends, a positive correlation between the euro in gold, meaning they both go up together and down together. And that is because the euro is the biggest component of the dollar index, and the dollar and gold are inversely correlated. And again, you can take your long-term charts, you'll see it clear as day. Just look at the trends. Don't overlay the prices. They won't match because they're not on the same scale. But that's the trend. So now what's happened? So the euro, we had a downtrend line here. This is a daily chart of the euro US dollar pair. So this is pretty much looking at how the euro is trading. If this goes up, the euro is going up. We had a little triangle there, breakdown. It's been volatile, but we put in this big divergent low recently, right? That's powerful in itself. But what's happened, the euro, with everything going on with Ukraine and Russia, the euro just got pummeled recently. It's been falling, but yet gold just broke out. So gold had a breakout finally and has been moving higher despite the euro falling. And to me, that's very bullish because it's simply overcoming it's the simple mathematical formula that the reason gold rallies when the dollar drops is because it takes more dollars to buy an ounce of gold if you hold supply and demand constant. But the thing about it is supply and demand aren't constant. And so what it shows is there's been an overwhelming demand for gold and silver lately despite a falling euro and rising dollar. The dollar had rallied recently. Today the euro's up. So now what I'm trying to get at here is, let's say this bullish falling wedge right here. See this big giant divergent low here on the daily chart? There's our downtrend line. I've moved around. I can't draw a perfect downtrend line. I had that one and that gave us a false breakout. But if you strip away everything and just look at the divergences here, big divergences, then if that plays out, I can only imagine what gold's going to do with a rallying euro and falling dollar. Again, work to be done. I wish I had a better downtrend line or something to trigger an objective long entry, but I just wanted to say that from a fundamental perspective that so far gold's been quite resilient in the face of a falling euro as of recently. So those are my outlooks. That is my outlook for gold and silver, and kind of more in trend trading mode with that as well. All right, let's wrap it up here and see what the markets do today. And I may have to leave town towards the end of the day, and if I don't, I'll get a video out at the end of the day. And if anything pops up before I leave, anything else I missed, I'll get that out to you as well. This has been Randy Finney with Right Side of the Chart. Have a great day.